Hi there and welcome to the Stockscores Market Minutes for March 19th, 2012. You can get my free weekly newsletter at stockscores.com/newsletters.asp, the address there on your screen. Well, this week I want to talk a little bit about how the economy has become so global in nature. Countries are more economically dependent than ever before. What we have are large companies like General Electric, Coca-Cola, who are doing business all over the world, and therefore they are dependent upon the health of the economies in other places. At the same time, you have small companies who may make money based on what happens on the other side of the world. A mining company in Canada might really be dependent upon what is happening in China, where the ore that they mine is used for manufacturing. So we always have to keep in mind that the economy has really become a global place, and therefore it's important to watch global markets and gauge their influence on the North American markets. Now, global markets are more pieces that help us complete the market's puzzle. And so on a regular basis, I like to look at the charts of some of the country ETFs that give us a clue into what is happening in some of these other countries. Now, there's many different index ETFs based on different countries. I've listed a few here, and we're going to go through the charts of these in a moment. But I have chosen China, emerging markets, the EEM, which is a very liquid one. There's a European ETF. There's a number of European ETFs. VGK is probably the most liquid one. And then you see there Japan and India and Australia as well. All right, now starting us off, we have a chart here of the FXI, which is the really liquid China index fund. And you can see that this fund has been moving higher since the late part of 2011, but it is still not really broken through that ceiling that is held up through the end of 2009, 2010, and 2011. So right now we're building a pennant pattern, and if we break that red downward trend line on that pattern, then we should move up to the longer term resistance. And so this is a chart that is improving, but it is still not a great chart. And so what that tells us is that the Chinese economy has stabilized, maybe improved a little bit, but it is still not a great economy in terms of what investors are getting in terms of returns. Emerging markets have broken its shorter-term downward trend line, and much like the Chinese market, building a consolidation pattern with hopefully a break to the upside, which would take us up to that longer-term resistance. So, you know, again, an economy or economies that are improving, but really don't look solid yet. Europe has stabilized, which is a solid outcome for Europe. And in the last couple of weeks, this chart has started to improve. So that may be a bit of a surprise given what Europe has gone through and all this talk about a recession in Europe. But the market is actually looking okay. Now, okayed isn't great. I mean, we're still well below resistance. We have a little bit of upside to that point. But ultimately, I think this market probably goes up a little bit and then goes sideways for a while. It should be a relative underperformer globally. Japan has recently broken its downward trend line and is starting to move up, but keep in mind that the Japanese yen has really fallen lately, and so this is a bit of an artificial rise, because when you consider how much the yen has fallen, if you bought Japanese stocks, then you wouldn't be doing all that great. Now, this, of course, is an ETF price in US dollars, so it adjusts for that. But the market in Japan has been doing well in terms of the index, but when you factor in the currency loss, it's not been that great. There's the India fund, and it has got a downward trend line. It's tickling that downward trend line, so pessimism in place, but it has the potential to break that pessimism very soon. Australia, being a commodity-based economy, has done a little bit better lately. But again, stuck in a little bit of a sideways trading range. We do have rising bottoms on the chart over the last 4 or 5 months, I would say. So that's encouraging. But again, that problem that keeps coming up, we've got resistance for this market to deal with. Now, the S&P 500, the U.S. stock market, has been really the top performer globally. Well, really the NASDAQ has been the better one, but the U.S. markets have been the top country performing funds, and they have done very well. We're coming into some resistance right now that may stall this. But generally speaking, this is the best looking market out there. Canadian market, I would say, is the second best looking market. It has broken its downward trend line, forming that rising bottom, but it really needs to break higher out of this little trading range that we've been in since really the start of February of 2012. Now, what's important for some of these global markets is what happens with the US dollar, and it was a little bit strong over the last month, but it's fallen back over the last week and I would say week and a half, and has set up a falling top. Now that means that it's likely to start to move lower. The question becomes whether it breaks down through that green line, because that would be a break of the optimism that has been building since late 2011. Now, if that happens, if we get a break of that downward, or probably that upward trend line there, then commodity prices should start to surge, and you'll see the Australian and Canadian markets do better. They haven't really caught on yet. These markets are pretty dead right now. But watching that U.S. dollar is very important because it will affect those commodity-based economies. Here's a chart of the VIX, which tells us a lot about fear, and fear is back down to 2007 levels. It's really fallen off quite sharply, and it is now at support. So I think that we'll see the VIX bottom out here. That kind of gives us a bit of concern because it means that investors are complacent about bad things happening, but in some ways it's also a positive because it shows that the concerns about Europe have really been put aside for now. Gold is in that long-term upward trend, but falling tops over the last little while. I think the upward trend will hold, but we're narrowing in the point of that pennant pattern right now, so we will get some resolution of whether gold breaks that long-term upward trend line or whether it can continue higher by breaking that shorter-term downward red trend line that I've drawn there in the chart. So gold should resolve itself in the next couple of months. Oil is in pretty much a sideways pattern, has been that way for some time. Now, if you talk about very short term over the last 4 or 5 months, oil has done well, largely because of Iran, but also because the economies globally are stabilizing. They're starting to show some signs of improvement, and that should help oil prices higher. Until we break out through that red line, however, I think oil is an okay place to be, but not a great place to be. So I am bullish on U.S. stocks, neutral on Canadian and gold, Canadian stocks and gold, and bullish on oil, but with a bit of a caveat because I don't think it has tremendous upside in the near term. Basically, the bulls have control of the market, but they are pretty selective where they're playing. Right now, the U.S. stock market is the place where they're active. And despite the recent gains, the optimism and confidence is not widespread. Globally, markets are stable but not looking strong. It's really only in the U.S. and then only in a few select sectors where we really see that strength. Well, that has been the Stockscores Market Minutes for March 19th, 2012. Have a great week in the market and trade well.